All right. Good morning. Good morning, everybody. We're there. It is OpEx. We are rebounding. So, although everything is red, um, the president said high tariffs on China likely will not remain. And then that kind of turned everything around. We'll see if it holds. Hong Kong up more than half, and Japan as well. So Dow basically flat, small caps down almost 0.75%. So if anything else, because of OpEx, we're likely going to pin for half the day or more, then the small caps might be something worth considering through the morning session and then into the afternoon when we go to do afternoon 0 days, could get an expansion. It's something anyways. Better than nothing. These numbers are basically in line if we would get them anyways, right? There's so many numbers that we're not going to get, but I'd be more worried if they were far off. It's going to be OpEx today and gotcha headlines. Anything that might come out that may be shock and awe, Friday data dump, that sort of thing. But the thing is, if we're going to get that flip today, or if things are going to change, it's certainly not reflected so far. So we're going to need to find where that flipping point is, or watch the breath and look for things to flip and come back the other way. A lot of times we already have the signals that we're looking for. And in this case, we don't have them yet. We're going to be looking for them later on. The call and put wall really didn't change. We're underneath the zero gamma and the volatility trigger. We didn't even get to the put wall. Another test of the 10-week. And we've got elevated trading volumes again. 293,000. That's the biggest number that we've seen yet, right? We had 217 earlier this week. So it's a significant amount of trading volume in the overnight. At this point, we've pretty much taken back everything from the headlines. So as usual, GTFO, the top of the box puts us back inside of yesterday's range. So it doesn't really get us out of a box other than it's our own box, right? It's the Globex range that we're working with this morning. The 4-period daily moving average is the Globex high. So get through that. Then the 10 and the 20 are stacked on top of each other. You can't really see them individually, but they are both there. 6692 cog line, which is also volatility trigger and zero gamma. That level is going to be hell to get through. 6,700 big options level, zero gamma, volatility, 10-day, 20-day, They're all stacked up right there. And there's a combo line. I'm not saying that we can't get through that level, but it's going to take a lot of push. Surprise headline, sustained flows. It's going to take something significant to get us through 6,700 today. Now, what would be better is if we could jump that somehow, say, between Friday close and Sunday open with some sort of gap up that gets us above those levels. And we've seen that before when a market finds a level that it can't get across, then it goes into the close and jumps it in the overnight. That's a real common occurrence, but that doesn't help us out for today's trading range. So, yeah, I mean, that at least it's simple. It's right in our face. Take what we can get. So we've already did the ADR. And now we're on our way back. We can go to the other side by the end of the day. That does not necessarily make us bullish, right? Just getting to the other side, because it's just a wave, right? Price makes its move down and then it makes its move back up. Even if we did get to that yellow line, it would be a lower high. So a lower high in this condition is not bullish. Still just topping out. The concern earlier this week was fading back below this midpoint. And I had mentioned we need to stay above it. Well, we didn't. We ended up closing below it and expanding lower. Getting below that line, I pretty much believed we were going to go down here to this 65.50. And the fact that we didn't is a nice little tell. So we still need to get into the open. If we don't get above this midpoint by the open, then I think we can still come down here and get this lower level. If we can get back above the mid before 9:30, then it offers more to the upside. But we still have that 6,700 level to deal with and all of that trash that was sitting there. We have a market maker move this morning, so they are hedging, maybe. And I say maybe because, well, it's OpEx. Now, OpEx by itself isn't necessarily going to affect the ES because it's not triple witching. This thing isn't expiring. But generally speaking, when we have an OpEx, we tend to see a market maker move signal. So rather than just assuming that they are hedging, we can come in and take a look around and see, well, what's being traded and how do we even get this market maker move, which is up here. Now, this is a Thinkorswim product. So if you're on a different platform, you won't have a market maker move signal, but that doesn't mean you can't see it for yourself. What it's doing is it's looking at the implied volatility average here on the side. And any platform that has options is going to give you the implied volatility average of that expiration. So we've got this 0-day right here at 23. And then we've got the next expiration out and it's at 19. When the front number is higher than the next number out, you end up with a market maker move. There's articles that you could read about this. If you was to go to Google and search market maker move, you'll find the ones that Schwab has. They never mention futures. They always talk about it from a perspective of earnings or catalyst events, but options are options. It doesn't matter if it's futures or not. And when there's hedging in the front end like this, it just tells us that they are adding additional protection for today. We know it's for today because these options are going to be gone by the end of the day. They don't have a choice. They're just not going to exist after today. So they are hedging, they are worried, they are concerned, but this thing can get goofy if it was triple witching or sometimes even just regular OpEx. It can mess with that thing because it's forcing them to trade out of positions that they had been holding for a while. And whether they're getting in or getting out, it's trade activity, and that can trigger the market maker move signal just because it's elevated trading activity within the out of the money option. So we just went and looked. This isn't a false signal. They are concerned, and it's a pretty good size. The last time we seen one of these, it was sitting at around 22%. This is at 62, 0.62%. So they're worried. They're putting some money on the line. And remember, for them, a hedge is not a trade short. It's just cost. Like starting a fire and throwing money in it. You're not getting it back. When retail trades a hedge, a lot of time all they're doing is just putting on a trade. It's not a hedge at all. And so you have the opportunity to make it risk-free and turn it into a trade and profit from it. When they hedge, it's just cost. And they're willing to spend it. That's how concerned they are. They're putting a lot of money out on the line, and to them, it's worth it. So whatever they are worried about, we should be worried about. Well, we looked at the economic data on the table today. None of it looked scary enough to warrant this level of protection, which means it's an unknown unknown. There's something coming, they're worried about it, and rather than trying to guess or assume or time it, they're just putting a hedge on today. It will be gone by the end of the day, so look for this thing to top out and then look for it to begin to fade. It's at 62 now. Once it gets below, say, 0.5, we know it's on the decline, and just keep your eye on it until it disappears. But we still have the upper levels here. Getting back to the upper ADR half should be easy enough. It's underneath that 67,000. We should be able to do that, no problem. Getting above that into 67.32 cog line or getting a breakout of yesterday's high, I think that's going to require a headline. If we can get above that, though, we got 67.50, which is just a little below the high of the week. Right? I think we made it up into 67.65 or something like that this week. $67.61-ish, something like that. 66. That's our high on the week. We could breach that if we can get above the 32 cog, but I don't see any reason that we get above 6,700 unless it's really good news. We are back above the weekly pivot. Hopefully we keep that. That's the second time this week that we've expanded below that weekly pivot to the lower edge. 65.92 cog line held on Tuesday, but we broke right through it this morning like it wasn't even there. Still, we're back above the 32 cog. We're holding it around 66.50. It's a big options level. It's a line in the sand. It is significant. If we can get through this, we have a missed daily pivot up here, 66.80. Markets want to hit their pivot. So the base case argument here is that we continue to move to the upside at least far enough to get that pivot. If not, on Monday, we'll look back and we'll say, hey, that was a missed daily pivot. Right now, it doesn't count because, well, at any time today, we could hit it, and then it won't be a missed daily pivot. It'd just be another pivot that we hit. The channel today is a little wider than yesterday. Wide channels imply that if we break out, the breakout doesn't stick. Price opened underneath it. That's bearish. Today's pivot's lower than yesterday. That's bearish. But we do have the expectation that we're going to run up and we're going to hit that level. We've already got S1. S1 offers R2. That would be 6,800. There's no reason to believe we're going to get anything like that, but we are back above R1. So if we can get above the floor pivot, that does offer at the bare minimum R1, 6732 cog line. Just so much trash overhead. $67.08 is the point of control for this week. So if we do get through 6,700 by some miracle, then we have the week's point of control overhead. It's a classic D-shaped profile too at this point. The P-shaped profile from last week really didn't seem to play out the way it should, but or the way it typically would, I guess, not should. But the classic D so far looking pretty good. No real tell on this low that we put in down here, at least on this time frame. And like we've talked about before, this zone has 4 different points of control to it. And they're not lined up, textbook perfect, but in the real world, you don't generally get textbook perfect. That 65.50 is a significant level. Lots of strength, lots of structure. It's going to be really hard to break that. And so far, it held on the first test on Friday. But you can argue we fell so far on Friday that by the time we got there, sellers were exhausted anyways. And that's when we stopped. We just ran out of time and sellers were exhausted and we went into the close on Friday. It's not like there was a bunch of buyers down there that ran it back up, because that's not what we saw. It would be interesting to note, if we get back down there again, if we're going to see any defense of that level. The area that I marked out is on the old contract. We're on a new contract. Anybody who was back here that had unfinished business, well, it's finished now because those contracts don't exist anymore. Ten-day, 30-minute volume profile in TPO. We still don't have anything concrete here, but we're building out this 6,700 area. We're leaving a lot of footprints in a wide swath, just like we did back here. So it's not hard to imagine that when the time comes, the point of control is going to drop down into this 6680 area. The key is whether or not we're going to be above it, just like we talked about earlier this week. So we need to get above that level, which is also the midpoint of last week. We need to get above it and close above it this week. Going into the weekend, we need above that level, right? That one right there at 66.77. Thinkorswim's moving in like slow motion today. Maybe I have to take out the trash. All right, two double distribution yesterday. Point of control across the top gives us a VPOC to deal with. I don't think we've got, yeah, we got one. We'll take that line. All right, I don't get this thing down to the narrowest tick. I just get it to the closest point. You do you. So 6732 cog line, it's yesterday's point of control. It is an untouched point of control, what we call a VPOC. So I'm going to carry that forward. The textbooks will tell you to carry forward all three lines, the value area, low and high, and point of control, but I've got enough pivots. I don't need all of that. So I don't. But, you know, it's not to say they don't have any value. While the lower distribution didn't get enough to bring that point of control down, it's still a significant level to focus on. So if you're looking for a break to the upside this morning, you got to get through this level 66, 60, 62, 64. It's a little bit of a zone. GTFO, right? You got to get through that. And that alone may be significant enough to hold us back to where we can't even test the mid from the week and then get back up to this point of control. But if we do manage to get through all of that, you still got this 6,700 up here. And there's a lot of stuff parked at 6,700. It's going to make it difficult to get through today. No real discrepancy this morning between the TPO and the volume profile either. These two are looking really well, really good. All right, like we do every Friday, we have a preview of next week's range. This is just a preview. The range is not set yet. It won't set until after the close today. Throughout the day, this range is going to expand and contract, and the gray line, which is supposed to be price, it's going to move up and down as price moves up and down. Then after the close, it'll lock into place. Now, there's math behind how this range is calculated, and the math is based on how many days do we have, and then what sort of implied volatility average do we have. So these ranges are based on actual trades being placed in the market, not something like a floor pivot, which is looking back at trades that already happened. These are trades that are ongoing right now, right? The options for next week are what fuels the math behind this, right? This one right here, 7 days out. Right now, the expected move is $190.75 or 3 ticks. What is it going to be at the end of the day? That's what's important. And we're going to carry that forward all of next week. Well, as they go in here and they trade these options, it's going to change this number. The more the out of the money options are traded, the more that number changes because that's what it is calculated on. Now, we don't know everything that it's calculated on because every broker has their own way of calculating this implied vol, and there's a little bit of a secret sauce to it, so they don't share all of the details. But we know that it's using the out of the money options on the calls and the puts, and it has a square root of time function in it. What else is in there? Yeah, they don't tell us. But we want to compare next week's range to the range that we've already had. Next week's a 5-day week. This week was a 5-day week. So we know the times are the same. That's not always true, right? You could have holidays, you could have a short week. But next week's 5, this week was 5, and yet next week is a bigger range. That means there's more volatility being priced into the market next week. So if you thought this week was fun, oh, you'll love next week because they're pricing in even more volatility than we had this week. Now, there's a little bit of a sneakiness behind all of this. If next week had a big event, a big known event, CPI, PPI, non-farm payrolls, FOMC, something like that, the range wouldn't get big because they're expecting a lot of volatility. It would actually get really small because those sort of events are volatility suppressing events. The market would expect to go sideways into those events. And if you have 2 days of sideways, then you don't have a 5-day range like you would normally have. So the fact that it's not narrow, or at least narrower, implies that whatever's causing them concern isn't on the economic calendar. It's something else. Now, it could be continued earnings, headlines, who knows, right? It could be a lot of things, but it's very likely not calendar related. If it was, it would very likely be a much smaller range. Now, just because they made it a wide range does not mean that we actually have to go anywhere. The week that we just had a really wide range, and we spent most of the week just chopping in a much narrower zone, right? So we will revisit this range on Monday and see what we actually get. But for right now, that's the projections, and we'll see. If you don't have this indicator, if you're on a platform other than Thinkorswim, after the close today, say around 4:30 or so, you can come in and this number won't be moving anymore. And then you can just write that number down. That'll be your range in one direction, right? So if this was 4:30 this afternoon, we'd look and say, well, it's 66.50. So we'd add 190 to the upside and we would subtract 190 to the downside. And that would be our range. Round up, don't round down, right? We got a lot of stuff that is down this morning. Uranium, gold miners, Bitcoin. But, with uranium, it was up 11%, 11% in 5 days. So, a little bit of a pullback is not hurting anything. That keeps everything from getting too parabolic and it's already, pretty wild. Gold is down, or gold miners, but they were up, what, 15% in a 5-day period. That's a bit much, right? So again, a pullback is not an unhealthy thing here, and it doesn't make me bearish just because they're pulled back a little bit. They ran a long ways in a short period of time. Now, Bitcoin's down, and over a 5-day period, it's down 7.25. It's kind of due for a bounce at this point, but probably not today. Over the weekend would make sense, right? Keep an eye on it. If you like trading in the weekend, Bitcoin's a nice way to go. And after being down, possibly 10% by the end of today, if it keeps headed to the downside, we could get a nice little rebound bounce over the weekend. China is down almost 2%, but it was up almost 5% in a 5-day period. That's not really stretched out for China, but still, it puts context into the 2% pullback today. We're still up on the week, all things considered. Metals and mining, same scenario as China. It was up on the week almost 8%. And now a little bit of a pullback, 1.5%. It's not that bad. So, when we put it into context, a lot of this pullback is just trying to calm the market down after making these exaggerated moves to the upside. Chips, the Mag 7 up volume growth, emerging markets as China again, bots. So yeah, sure, a lot of things are down, but I would not run out there and try to get heavy short in this market. It's really a stock picker's market at the moment, selectively choosing your shorts, not a broad basket short into this market. Banks are up a little bit, 1%, but they're still down, more than 3.5 overall. They were down like close to 5 in a 5-day period. And bond volatility continues to decrease, which is a good thing, right? We want that bond volatility to calm the heck down. Boy, it's a bright screen. All right, solar is up. We don't want a rally day based on solar. That's a joke. And then staples, it kind of feels like a flight to safety and a very weak capital rotation at that. I would not expect that to hold. Look to wash that out and get the Mag 7 coming in to take its place, get a little bit of a short-term swap in the money between staples and consumer discretionary. And then looking at the leadership to the downside, it's junior miners, uranium, then miners. The VIX is down. Bitcoin, China, hot stocks, silver, agriculture, healthcare, chips, tech, mags. At the very least, if we get a capital rotation this morning, it will be very obvious, right? It won't be subtle, and it would need to be swift because, more than half the day is done already. If we're going to change things around, it needs to get going. My base case argument for today is that we hold the line and we just go silently into the close, but it's OpEx day. So there's a bare minimum sort of bias that says, at least for the first half of the day, we pin towards those biggest levels that we've had on the table. And then in the second half of the day, with those gone, it's fair game and we could actually expand into the weekend like we did on Friday. I shouldn't have said that because that makes people think I'm pointing to the downside. Friday was a big expansion day. I don't care that it was red. It's still just an example of a big expansion on a Friday. We can get a big expansion on a Friday in any direction, up or down. If we get above that 6,700, it's game on. We could get all the way back up to 68 today. But there's just so much structure at 67. I find it hard to believe that we'd be able to get through there other than say we get into it and we overshoot into the 6711 cog line or something like that, and then we flip. We can wick above it, but I don't see us getting above it and keeping it and running higher. That'll be where the bias changes. If we do get above it and we keep it and continue to push, then okay, we'll run it to the upside. And if that happens, we got plenty of room. We'll run it to the high 67.50. And if we get through that, then we take out Wednesday's high, and then we run for the roundy 6,800. There's plenty of room, so that if I'm wrong, I'll get my hand slapped on that, and then we'll just make it back and make more on the run up. Works for me. That's what I got for you guys. Be careful, be safe, enjoy the weekend. I'll see y'all on Monday.